Welcome back to Empowerment Library, where books shape better lives. In our last episode, we unlocked ancient wisdom with The Obstacle is the Way by Ryan Holiday, a powerful reminder that the path to greatness lies through challenges, not around them. Today, we shift gears from stoic strength to financial intelligence. We're diving into one of the most legendary books ever written on investing, The Intelligent Investor by Benjamin Graham, the mentor of Warren Buffett himself. This isn't just about stocks or markets, it's about mindset, discipline, and long-term thinking. Whether you're a beginner or already investing, this timeless classic holds the keys to building real wealth with wisdom, not luck. So get ready to think smarter, invest wiser, and take control of your financial future. Let's begin.
Part 1. General Approach. In Part 1, Benjamin Graham lays the foundation of what it means to be an intelligent investor. This part is not about beating the market but about developing a disciplined, rational, and emotionally stable mindset. Graham separates investing from speculation and introduces the core idea that intelligent investing is more about character than intellect. The intelligent investor focuses on preserving capital, seeking reasonable returns, and avoiding major errors. This part also introduces the two types of investors: the defensive, passive, and the enterprising active. Both can be successful if they apply consistent, sound principles. Graham makes it clear that true success in investing comes from patience, knowledge, and control, not cleverness or timing. Chapter 1. Investment versus speculation. Graham defines investing as buying with thorough analysis, aiming for safety and satisfactory returns. Speculation, on the other hand, is chasing price movements and trends without regard for value. Most people unknowingly speculate, mistaking it for investing. Graham warns that speculation is not wrong, but it must be done with full awareness and limited exposure. Intelligent investors must avoid emotional traps and hype-driven decisions. The market is unpredictable in the short term, so a careful and methodical approach is essential for long-term success. He stresses that good investing is boring, not exciting. Chapter 2. The Investor and Inflation. This chapter highlights the danger of inflation, which silently reduces the purchasing power of your money. Graham notes that fixed-income securities like bonds are especially vulnerable. While stocks offer better long-term protection, they also come with higher volatility. Graham advises investors not to overreact to inflation fears but to be aware of its impact. Diversification, asset allocation, and long-term thinking are key defenses. He doesn't recommend exotic hedges, just a balanced and thoughtful portfolio. The intelligent investor must plan for inflation without panicking over it. Chapter 3. A Century of Stock Market History. Graham provides a historical review of stock market behavior from the past 100 years. He shows that markets move in cycles, booms and crashes are normal. Investors often get caught up in euphoria during bull markets and fear during crashes. Graham's message is clear. Don't expect markets to behave rationally in the short term. By studying history, investors can avoid being surprised or misled. Trends come and go, but principles endure. Successful investing depends on staying grounded during both extremes. Chapter 4. General Portfolio Policy: The Defensive Investor. Graham outlines a simple strategy for the defensive investor, someone who wants minimal effort with maximum safety. He suggests a 50-50 split between stocks and bonds, adjusting based on market conditions. The defensive investor avoids speculation and flashy trends, instead focusing on stability and income. The key is consistency and a hands-off approach. Diversification, high-quality holdings, and periodic reviews are all that's needed. This approach won't make you rich quickly, but it will keep you safe and steadily growing. Chapter 5. The Defensive Investor and Common Stocks. For the defensive investor, stock selection should be conservative and rule-based. Graham recommends buying large, financially sound companies with a history of consistent earnings and dividends. He urges investors to avoid hot stocks and fads. Screening for value, earning stability, and a moderate price-to-earnings (P/E) ratio ensures safety. The goal is not to beat the market, but to protect capital and earn a reasonable return. Defensive investing is more about discipline and patience than predictions or excitement. Chapter 6. Portfolio Policy for the Enterprising Investor. This chapter introduces the enterprising investor, someone willing to spend time and energy for potentially higher returns. Graham warns that this path is more demanding and not suited for everyone. Enterprising investors seek bargains, neglected stocks, or special situations through deep analysis. They don't chase trends, they investigate value. Success here requires strict discipline, continuous learning, and emotional control. The line between investing and speculation is thin, so clear thinking is essential. Effort alone does not guarantee success, strategy does. Chapter 7. The Enterprising Investor and Common Stocks. Graham gives practical guidance for enterprising investors on choosing individual stocks. Look for companies with low price-to-book and PE ratios, stable earnings, and little attention from the market. These unloved stocks often offer better value. Avoid glamorous growth stocks, they're usually overpriced. Success comes from identifying mispriced assets, not predicting the future. Enterprising investing is like bargain hunting. It takes time, effort, and patience. Emotional stability and skepticism are vital traits for those walking this path.
Part 2. Understanding Market Behavior. In Part 2, Graham dives into the emotional roller coaster of market fluctuations. He teaches investors how to develop a rational mindset and avoid falling into the traps of greed and fear. The intelligent investor doesn't try to predict or outguess the market, they use it as a tool. Graham introduces the iconic allegory of Mr. Market, a business partner who offers to buy or sell daily, but his mood swings wildly. The investor's job is not to follow Mr. Market, but to exploit his irrationality. This part emphasizes patience, discipline, and the power of long-term thinking amidst short-term noise. Chapter 8. The Investor and Market Fluctuations. This is one of Graham's most famous chapters, where he introduces Mr. Market, an emotional, unstable character who offers daily prices for stocks. Sometimes he's euphoric, sometimes depressed. The intelligent investor doesn't react to Mr. Market's mood but uses his irrational offers to buy low and sell high. Graham advises investors to treat market prices as an opportunity, not as guidance. Ignore daily volatility, focus on the intrinsic value, and invest with logic, not emotion. This chapter is a powerful lesson in mastering market psychology and sticking to your plan. Chapter 9. Investing in investment funds, mutual funds. Graham evaluates mutual funds and investment trusts, pointing out that most do not consistently outperform the market. He warns investors not to chase performance but to examine a fund's long-term record and fees. Mutual funds can be useful for defensive investors if chosen carefully. Low-cost, diversified index funds are ideal for most. Graham discourages trusting hot fund managers or short-term winners. The lesson is to keep it simple, control costs, and remain skeptical of flashy marketing. A disciplined, low-cost approach will outperform most active funds over time. Chapter 10. The Investor and His Advisors. In this chapter, Graham discusses the role of financial advisors. He explains that while advisors can offer value, they are often influenced by their own biases or incentives. The intelligent investor should be cautious and informed when choosing professional help. A good advisor is one who focuses on long-term goals, understands the investor's temperament, and discourages emotional decisions. Graham emphasizes self-education. Even if you use an advisor, you must still take responsibility. Avoid yes men, and find guidance rooted in principle, not prediction.
Part 3. Choosing the right investments. In Part 3, Graham shifts focus from market behavior to selecting individual securities. This section outlines how both defensive and enterprising investors can construct a rational portfolio based on their risk tolerance and time commitment. Graham warns against speculation and emphasizes understanding what you own. He discusses bonds, stocks, convertible issues, and the crucial principle of margin of safety. Throughout, Graham maintains that disciplined research, sound valuation, and emotional control, not market timing or stock tips, form the foundation of successful investing. Chapter 11. Security Analysis for the Lay Investor General Approach. Graham empowers the average investor with basic tools of stock analysis. You don't need to be a Wall Street expert to succeed. Rather, focus on fundamental factors like earnings, dividends, and financial strength. He encourages comparing a company's price to its intrinsic value and not chasing fads. Simplicity, consistency, and skepticism toward market hype are vital. This chapter builds the foundation for rational security selection. Chapter 12. Things to consider about per-share earnings. Here, Graham cautions against blindly trusting earnings per share, EPS. Companies can manipulate or smooth earnings, and investors must dig deeper. Look for quality of earnings, sustainable profit sources, and consistent performance. Understand that short-term earnings don't always reflect long-term value. Be especially wary of non-recurring items or accounting gimmicks that distort reality. The intelligent investor seeks clarity, not illusion. Chapter 13. A comparison of 4 listed companies. Graham presents real-life examples of companies to show how investors can evaluate value. He compares financial ratios, earnings trends, and market prices. The key takeaway is that differences in market popularity don't always align with financial soundness. Some overlooked stocks may offer greater value than flashy names. This chapter teaches investors how to apply theory to practice by reading between the numbers. Chapter 14. Stock selection for the defensive investor. For the conservative investor, Graham recommends simple yet strict criteria for choosing stocks. Focus on large, financially strong, and consistently profitable companies with moderate price-to-earnings and price-to-book ratios. Diversify across industries. Avoid trying to time the market or chase growth. These guidelines help create a stable, low-risk portfolio that offers reliable returns without constant monitoring. Chapter 15. Stock selection for the enterprising investor. Unlike the defensive investor, the enterprising investor is willing to devote time and effort. Graham recommends seeking undervalued or overlooked companies, special situations, and bargain stocks. However, he warns not to confuse speculation with intelligent investing. The enterprising investor must demand a margin of safety and maintain discipline to avoid emotional traps. It's about effort with prudence, not gambling. Chapter 16. Convertible issues and warrants. Convertible securities offer a mix of bond safety and stock potential. Graham explains how these instruments can benefit investors if priced reasonably. But he also warns that they're often overhyped and overpriced. Warrants, too, are speculative unless acquired cheaply. The lesson is clear. Don't be dazzled by hybrids. Evaluate them with the same rigor as any security. Chapter 17. 4 extremely instructive case histories. This chapter analyzes real investing failures and successes. Graham dissects 4 companies, showing how investors were misled by hype, ignored fundamentals, or failed to diversify. These case studies reinforce earlier lessons. Investors must remain skeptical, demand value, and avoid emotional decisions. Learning from mistakes, your own or others, is essential to long-term success. Chapter 18. A comparison of 8 pairs of companies. Graham compares similar companies in pairs to illustrate how different financial fundamentals can be masked by market perception. 2 companies in the same industry may have drastically different value metrics. The goal is to train investors to spot these differences and make rational choices. Again, it's about value over popularity. Chapter 19. Shareholders and Management's Dividend Policy. Here, Graham explains how management's policies, especially around dividends, affect shareholder returns. He encourages investors to favor companies that reward shareholders consistently, rather than hoard earnings or overexpand. Graham also urges shareholders to act responsibly and not be passive. Understanding how management treats investor capital is key to judging company integrity. Chapter 20. Margin of Safety as the Central Concept of Investment. This is the heart of Graham's philosophy. Margin of safety means buying securities at a significant discount to their intrinsic value, so that even if things go wrong, your downside is limited. Like a bridge built to support 30 tons but used by 10, investments should have a buffer. It's the ultimate protection against uncertainty, bad luck, or bad judgment. No principle is more important or more ignored by modern investors.
Appendices. The appendices in The Intelligent Investor serve as critical additions, reinforcing Graham's principles with deeper insight. They offer valuable comparisons between defensive and enterprising investors, explaining how temperament plays a bigger role than intellect in success. Graham includes historical market data, investor case studies, and critiques of speculative behavior to prove that patience and discipline triumph over trends. Notably, the appendices highlight margin of safety and intrinsic value using real-world data to show their effectiveness over time. He warns against relying blindly on financial forecasts or flashy metrics. These pages act as reinforcement, reminding readers to stay grounded, rational, and principled. Together, they turn the book into both a guide and a reference manual. Conclusion. The Intelligent Investor isn't just a book, it's a mindset. Graham's message is timeless. True investing isn't about being clever, but about being disciplined, rational, and cautious. Whether you're new to finance or seasoned, this book offers a steady hand in a volatile world. Its greatest lesson? Protect yourself from yourself, your emotions, your greed, your fear. As we close this journey, remember, investing is not about beating others at their game, but about controlling your own behavior. Stay smart. Stay safe. And stay focused on the long term. Coming up next on Empowerment Library, The 5 a.m. Club by Robin Sharma. Unlock the secrets of mastering your morning and transforming your life.